private equity funds are finding it more difficult than ever to exit their portfolio companies. Portfolio companies are the companies that are owned by the private equity funds. You see, in 2014, 2015, 2016, and 2017, private equity funds were able to raise quite a lot of capital from investors. But now that they've purchased companies, it's hard for them to sell the companies and provide liquidity to their limited partners. Or in other words, it's hard for them to sell the companies and be able to give money back to their investors. Now, investors are frustrated by not receiving capital. And so private equity funds are finding more creative ways to get the money from the private equity fund back to the limited partners. Some actually include not even selling the company. Because of this, Bain Company conducted a survey amongst investors to figure out their preferred methods of liquidity. In other words, their preferred methods of how the private equity fund gives them their capital back. Today, we're going to talk about the top 5 preferred methods that limited partners or investors have said that they've preferred through the survey in Bain Capital. Number 5 is NAV facilities. This is when the private equity fund borrows against all of its portfolio companies and uses that loan to provide a distribution or a payment to investors. So none of the companies are sold, but the group of companies are borrowed against, they're used as collateral, so that the private equity fund has more money to give as a distribution to limited partners. Now, to learn more about NAV lending, we have a full video on YouTube called NAV Loans, Everything You Need to Know. So please check that out if you want to learn more. Number 4 is a continuation vehicle. When a private equity fund has a company or companies that it wants to sell, it could sell those company or companies to itself through a continuation vehicle, which it creates to hold those new companies. Now, when a private equity fund sells this to itself, it gives its current investors, its limited partners, the opportunity to roll over their stake into the new vehicle or to take a liquid payment for the companies, which is a form of liquidity for the limited partners. Now, this is a complex topic. So to learn more about continuation vehicles, also known as continuation funds, please check out our full-length YouTube video titled Continuation Funds, Everything You Need to Know. Number 3 is LP-led secondaries. This is when the investor, the limited partner, sells their stake in a private equity fund to another LP. So they get liquidity by selling it to themselves. Now, this is called an LP-led secondary because it's led by the limited partner. Continuation vehicles that we talked about in number 4, well, those would be classified as a GP-led secondary because it's the GP, the private equity fund, that leads the sale. We have a video titled Private Equity Secondaries, Everything You Need to Know, that talks about all type of secondaries. So let's move on to number 2, which is a dividend recapitalization. Now, a dividend recapitalization is when one of the portfolio companies in the private equity fund is able to recapitalize. In other words, it is able to take a loan on the company and then pay a dividend using the money from the loan. And the dividend will flow through to the private equity fund to the investors, providing liquidity to the LPs. We've talked about dividend recapitalizations in many of our videos. So what is the number 1 way that limited partners, investors in private equity funds, want to receive their capital back from private equity funds? Any ideas? That's right. It's through conventional exits, by selling a company to a strategic buyer, a financial buyer, or by bringing the company public, usually through an IPO. Limited partners are frustrated with private equity funds for not returning capital through conventional methods. They want private equity firms to sell the companies to strategic buyers, financial buyers, and to the public markets at the net asset value that private equity funds are saying their companies are worth. By using instruments such as NAV loans, continuation vehicles, as well as by doing dividend recaps, private equity funds are giving capital back to investors without the investors fully realizing the full net asset values that are promised. It'll be interesting to see how the private equity industry evolves. Will private equity funds be able to find more conventional ways to exit their portfolio companies? Or will private equity funds continue to come up with creative ways to return capital to investors? I guess time will tell.